Welcome to the 255, where we make business easy. If you ever felt overwhelmed by the complexity of running your business or unsure about the right steps to grow profitably, then you're in the right place. I'm Arnold Shields, and I specialize in breaking down complex business challenges into simple, actionable steps that anyone can understand and implement. In this podcast series, we'll talk about a powerful framework I've developed called the 255. It's about two fundamentals, 5 multipliers, and 5 foundation stones that form the blueprint for building a thriving and sustainable business. Whether you're just starting out or running an established company, this framework gives you the tools to make smarter decisions, increase profitability, and unlock the full potential of your business. Why listen to the 255? Because running a business shouldn't feel overwhelming. My mission is to make even the most complicated aspects of business easy to grasp and practical to apply. From understanding cash flow to leveraging the growth multipliers, I'll share strategies and insights to help you take control of your business and build long-term value. In the last episodes, I covered the 3 sales multipliers: leads, conversion rate, and average dollar sale. Increasing sales is a function of increasing the number of leads, which is your marketing department, increasing your conversion rate, which is your sales department, and increasing your average dollar sale. So in order to get like an exponential increase in sales, we don't have to find that one big sale or customer. We just may need to make consistently small increases to the number of leads we generate each month, then make small adjustments to our sales offer, testing which ideas work to improve our conversion rate, and then increasing our average dollar sale by simply increasing our price, or adding by upselling or cross-selling, by getting your customers to add more goods and services to their order. We just need small increases, a few percent a month, a 3% increase in the number of leads each month, a 3% increase in conversion rate, like from 10% to 10.3%, tiny increases, and a 3% increase in your average dollar sale by adding simple bundles or offers. These would result in doubling your sales in 1 year. So today we're going to deal with the 4th multiplier, the contribution margin. And while the other multipliers are kind of easy to measure and understand, the contribution margin is trickier and it has more component parts, and the nature of the contribution margin will be different for each business. So if we take a simple view, we consider the gross profit rate. Typically, the gross profit is sales less the cost of goods sold. The cost of goods sold is typically just the cost of products that have been sold. And the gross profit rate is your gross profit divided by sales. So sales, your sale price in particular, is going to be a major part of your contribution margin. So if we look at it in terms of just the gross profit rate, that's a bit simplistic for our needs. We need to expand it to include the cost of leads and the cost of conversions to arrive at a contribution margin. So sales is easy to measure. We need to break it down into its component parts: leads, conversion rate, and average dollar sale. But it's pretty easy to measure. Your e-commerce platform, your website, your bank account is going to tell you what your sales are quite easily. And I think that a lot of people focus solely on sales because the data is easy to get. You can probably have an app on your phone that you can easily check a few times a day, depending on your business. But the contribution margin is more difficult to measure. You're going to need an accounting system like Xero or QuickBooks, and you need to have it up to date. So we can't be sitting on something and we look at it each year. We need to be looking at your accounting system on at least a monthly basis, and it needs to be up to date, because otherwise we're not going to be able to tell whether your contribution margin has increasing or decreasing. And remember, we're only looking at small increases and small decreases that can result in exponential growth. So you could think that your sales are actually going through the roof because you're doing a advertising campaign, or your PPC's working, or you're offering this special discount, and we've got all those other multipliers going up, but they could be resulting in your contribution margin decreasing to the extent that it offsets any positive gains you've made in the other multipliers. So you're going to find your contribution margin in your profit and loss statement. Now, profit and loss is simply income less costs. There's no rule about how the profit and loss is set out. So your accountant has probably set it out to do, for the taxes, which is really as simple as income less costs. That's what we need to calculate the costs. We don't need this other information. We need to set your accounting system up so that it gives you the right information, so you can understand what that contribution margin is. We can have multiple formats of a profit and loss, all for different purposes. So we can have one format that we use for calculating a tax and another format that we use for running a business. We want to set it up and we want to rearrange your profit and loss so that it gives you the right information. Now, most accounting packages, there is an opportunity to rearrange that accounting system to whichever way you like. That is sometimes a little complex in ways. And what we usually find, it's best to export that information into something like Excel and then rearrange it the way we want it. And then later on, we can create a permanent report in our profit and loss in our accounting system. So the easy way to do it is, rather than try and create a special report, is put it into export the information into Xero or into Excel and then rearrange it the way you like. And then you can say to your accountant or do it yourself, we can put those, use their report builders to create the exact system you want. So what we want to do is rearrange a profit and loss statement so that it shows you the contribution margin properly, because we want extra information. We want to sort the data differently. And we want to show the percentages for your contribution margin. We want to basically show 4 different totals that make up your contribution margin. We want to show direct variable costs, direct fixed costs, the costs of leads, and the cost of conversions. Now, I'm going to go into each of these shortly, but what we want to have is a percentage of sales for each of these items, because it'll make understanding how your business works and reacts to changes much easier. We want to simplify your business into some simple KPIs, key performance indicators, so that when you look at your profit and loss, you understand instantly what is going on. Your contribution margin is 2 parts. So there's the contribution profit divided by your sales as a percentage. So your sales price is going to have a major impact on your contribution margin. And the lower the contribution margin, the greater the effect on your profitability with a reduction in your sales price. For example, assuming you have a 50% contribution margin and you reduce your sale price by 10%, so we're offering some discounts of 10%, then your contribution margin will be 44%. So you've got 10% reduction in sale price, but your profits are going to reduce by 11%. If you have a 20% contribution margin, so we're looking at a lower contribution margin business, and you discount your prices by 10%, then you can reduce your contribution margin to 11%, which is a 78% reduction in profits. Alternatively, if you've got a 20% contribution margin and you increase your sale price by 10%, you could increase your contribution margin to 27% and increase your profitability by 36%. So we've got a 10% increase in price results in a 36% increase in profitability. Now, you don't have to increase those prices in one go. Remember, it could be a series of small increases over time. A simple question is, what would you have to do to increase your prices? An extra service or a value add to your offer? Marketing campaigns to replace any lost customers? Changes to your sales offer to be able to increase your conversion rate? Often increasing prices makes no difference to your sales volume. You just have more profit. One of the things we talk about with clients is, have you tried increasing your price? Are you actually selling at the optimum price? Remember, if you're selling products and you increase your price and your sales volume falls, well, sometimes that's a better thing. You're selling less products at more profit. So let's look at the parts of the contribution margin. So the first one we've got is direct variable costs. So these costs are directly related to revenue, to your sales, and are variable in nature. So they increase or decreases as your sales increase and decreases, such as the cost of your products, freight and handling, fulfillment costs. Then we have direct fixed costs. And these are quite often shown in the profit and loss below the line in terms of they're shown as expenses. And as a result, they're kind of hidden. And what I like to do is take these direct fixed costs and move them above the line. So move them up into that cost of goods sold section. But direct fixed costs are those costs that are related to the sales of goods and services, but the amount is not fixed or it's partly fixed in relation to sales. For example, storage costs of inventory is directly related to the sale of products, but those costs are in relation to the number of units in inventory, not the number of units sold. Services businesses is going to be wages is going to be a component part. So for our accounting practice, we have the wages of our accounting staff will be in that direct fixed costs. Then we have the costs of leads. So the costs of acquiring your leads, advertising costs, email subscriptions, social media costs, marketing costs, the costs of your marketing team. The cost of those leads contain variable costs, which are linked directly to sales, such as, say, PPC costs, advertising, and fixed costs such as email subs or the wages of your marketing team. And then we have the costs of conversions. So the cost of conversions might be your website costs, Shopify, etc., your subscriptions, and the cost of your sales team. Let's look at the nature of the contribution margin. So the contribution margin is going to contain variable expenses which increase or decrease in line with sales in the same proportion, and fixed expenses that stay the same, doesn't matter how much you increase or decrease the sales. So as we increase sales, variable expenses will increase at the same rate. So the ratio of variable costs and sales will remain the same, and your contribution margin's going to remain the same. But as you increase sales, the ratio of your fixed expenses to sales will decrease. And that's therefore, as increasing sales is actually going to reduce your contribution margin. Now, this usually happens in steps, as fixed costs will apply to a band of sales volume before we have to employ more staff. So depending on your type of business, you may have a high proportion of variable costs. So our e-commerce business has a high proportion of variable costs, such as the cost of our product, the cost of fulfillment, the cost of Amazon fees, etc. Those represent a high proportion of variable costs. And we have in our e-commerce business, we have very little in the way of fixed costs. Okay, so typical one is we've got probably 3 to 5% as the fixed costs portion, and we have maybe 60, 70% in the variable costs compared to sales. In our accounting business, however, we have a high proportion of fixed costs and very low variable costs. So in our accounting business, the main fixed cost is going to be the cost of our wages. So depending on the business, it's going to be different for each one. So generally with selling services, your contribution margin is going to be higher in fixed costs, being wages, and the way that you increase your contribution margin is by becoming more efficient with those wages. So that's how you bring that down, and also by increasing your sales volume. What we're aiming for is a high contribution margin. High contribution margins enable you to grow faster with less risk. So you've got more cash flow, more profits, and more flexibility. Remember, if you've got a 10% contribution margin and you incur an extra $1,000 fee for something, then you've got to get $10,000 in sales to cover that extra cost. Okay. If you've got a high contribution margin business, like 50%, you only need $5,000 in sales to cover that extra costs. So high contribution margin businesses have got a lot more flexibility to offer with them. If you're running a low contribution margin business, then you need to think about, you need to be really efficient across all the sections of your business. You have to be really tight with how much everything costs, how much everything you're spending, and really efficient with how you use your money and the assets you've got, things like inventory. If you're running a low contribution margin business, you need to be really efficient with your supply chain. If you're running a high contribution margin business, and depending on the size, you've got a lot more flexibility there, because if you make a mistake, and in every business you make mistakes, then you've got a far better chance of recovery. Whereas if you make a mistake in a low contribution margin business, it's going to hurt. So let's look at how the multipliers fit together, because as a business owner, you really need to understand how these multipliers fit together for your business. So we need to keep them in balance. The object being is to increase them all together, but that always not possible, but you can do it. So let's look at some of those typical business decisions and see how they affect the multipliers. So let's take a couple of examples that we've done for our business. So we're running an e-commerce business predominantly on Amazon, and we decide to try Google advertising as a way of increasing basically the number of leads. So how it affects the multipliers. So we want it's going to increase the number of leads because we're getting more people in to see our product pages. We assume that the second multiplier stays the same, but it might decrease because they're the wrong leads. Now, in the case we had, the Google advertising got more leads, but they were a different type of person to the people on Amazon. The people on Amazon are going there to actually buy things. People going to Google are going there to research. So whilst we increased the number of leads, we actually decreased our conversion rate because they didn't affect. The next one is we didn't have any changes to the third multiplier, the average dollar sale, because we weren't offering any discounts or bundles or things like that. And we decreased our contribution margin because the cost of the leads increased. So the cost of the Google advertising was the reason for the decrease in the contribution margin. So that actually, we increased leads, however, we decreased our conversion rate and we decreased our contribution rate. We didn't actually get a great number of sales from that. So basically we lost money on it. Another example is we want to increase our conversion rate. So with each of these decisions you're making, you are targeting which of the multipliers you're going to hit. So we want to increase our conversion rate by developing new photos, getting better photos on the basis that gets us more people are willing to buy. So we're going to assume that it doesn't increase the number of leads. In an Amazon business, if you increase your conversion rate, then chances are your product is going to rank better and therefore show up higher in the search results, therefore you'll get more leads. But if you're running a Shopify business or an e-commerce business, that is unlikely to affect the number of leads you've got. So let's say we aim to increase the conversion rate. So yes, average dollar sale, no change. we've got a reduction in the contribution margin because we've increased our direct fixed costs, being the cost of photography. So if we looked at it and did some calculations, you can actually work out if we spent $3,000 on a photographer and basis of 100,000 in sales a month or a year, then we would need to increase our contribution margin by 15%, so from 10% to 11.5% to cover that cost of that contribution of the photography. So let's look at another example. Amazon's always offering, Black Friday sales. You're going to get so many more sales if you do this. You've got to offer a 20% discount for the Black Friday sales. So let's say Black Friday sales are in. You offer 20% discount. We're going to increase the number of leads by 100%. So we're going to double the number of leads, and we're going to double our conversion rate. So we're going to go from, instead of 2,000, let's assume it's one day, instead of 2,000 leads in one day, we're going to get 4,000. Instead of 10% conversion rate, we're going to get a 20% conversion rate. Instead of selling our product for $20, we've got a 20% discount on it, so we're selling it for $16. And that means a couple of things. So our contribution margin, our costs are kind of the same. We're excluding any costs of being the Black Friday sale. Our costs of contribution are going to be the same at $14. So what happens is we've got our leads up, the contribution, the multipliers, the leads are up by 100%, the contribution margin's up by 100%, our average dollar sale is down 20%. So that means, a $20 product, we go from sales of $4,000 to sales of $12,800 for the day. So we're saying fantastic. However, our contribution margin falls from 30% to 12.5%. And so on a normal day, we would say $4,000 would make $1,200 profit. We've gone on this Black Friday sale. We've got $12,800 in sales for the day. Fantastic. However, we've only made $1,600. So we've made an extra $400, but we still have to go and replace that product as well. We've sold an extra 600 units that we could have possibly sold at a later time for those profits. Yes, it did increase in sales, but in profit, but it wasn't as great as we expected. So we need to think about how the multipliers work together for each business decision you make. So in terms of a business decision process, we're going to go, how is what we're going to do affect the multipliers? What multiplier are we targeting? Are we targeting leads, conversion rate, average dollar sale, contribution margin? And then what's the effect on the other multipliers? Are they going to go up or down? Now, we might have a new idea that's going to increase your leads, increase your conversion rate, and increase your average dollar sale. Absolute winner. Okay, we're going to go with those. We just have to consider, what's the cost on our contribution margin? But it could be a new idea, a new ebook, a new way of marketing that produces these fantastic results. So once we've looked at the effect on the multipliers, we need to think about what's the cash flow effect. What's the immediate cost, and then what is the cash flow benefit that we're going to get from it? And the multiplier is going to give you some idea as to what that benefit is, but we need to consider the cash flow effect. In the example of the Black Friday sale, we need to consider the cash flow effect of we've got to go buy an extra 600 units to replace the ones that we sold over the Black Friday sale. So there's a cash flow effect on that. And we didn't generate that much profit from that Black Friday sale to actually replace that product. And then we think, what is the risk? What can go wrong? How likely is it to occur? And how can we mitigate it? We look at the Black Friday sale. The sales might not be as high. Okay, that's a risk we might need to take. Now, okay, it's only going to last for one day. We might be right on there. Can we generate an extra $750 or $250 for the Black Friday to put our sale in the Black Friday sales for Amazon? Maybe so. So how can we increase our contribution margin? Well, remember there's four components. The first one being direct variable, cost of product, freight costs. Can we buy the product a bit cheaper? Can we get a discount for ordering more? But remember, with ordering more, discounts, savings you might get, there's a cash flow effect, and then there's also a risk of overstocking. We look at fixed direct. Can we basically increase our efficiency? Often in fixed costs, we can't actually get things cheaper. We might not be able to employ people cheaper, or we can't get better rates on our storage. But the key to fixed direct is being able to be more efficient or actually selling more. I mean, storage costs as an example. Our storage prices did not change. Have we improved our supply chain so that we could didn't need to carry as much inventory? So we made the savings by being more efficient with our supply chain. We, in our accounting business, we change our systems and processes so that our staff are spending more on chargeable work and less on admin. In cost of the leads, it's about being more efficient. What is the cost of generating that one lead? Typically, we can reduce the cost of leads by getting rid of the high lead cost items. In PPC, we look at figures like ACOS, and where we look at the cost of the lead, the ACOS is being higher than the contribution margin. If we're looking at a PPC campaigns and they're quite well structured, we can usually look at some of those keywords and some of those product terms they might be generating sales, but they're really expensive. And we can actually reduce those, actually get less sales, but make more profit because we're getting rid of those ones where we're making a loss. Over the next couple of episodes and over the future episodes of this podcast, we're going to come back to this contribution margin more because it is a difficult concept to think about. But in the first instance, what you need to think about is, what is your contribution margin? Do you actually know? And is it increasing or decreasing? So you need to have a look at your financial statements and have a look at your profit and loss and then start going through that. I always start to bring this, easiest way to start with this is take your profit and loss and by month and then look at it in terms of drop it down to Excel and then do some simple calculations. Okay, are sales going up or down? Change your layout so that you're moving these things into variable direct and variable fixed direct, and your cost of leads, cost of conversions. And so you can start to understand what these percentages are. And what you're looking for at the moment is which direction they're going in. Are you getting an increase in your contribution margin or a decrease? Now, if you're getting a decrease, then you need to think about what you need to do about it. And sometimes, depending on the speed of what it is, you may need to make some decisions very quickly. Okay, in the next episode, we're going to talk about the valuation multiplier, which is the final of the multiples, before we go on to some other topics along the way. So I look forward to next week, and thank you very much. If you've enjoyed today's episode, make sure to subscribe on Shopify or Apple Podcast or YouTube so you don't miss out on upcoming episodes. If you've got any questions or topics you'd like me to cover, reach out to me on LinkedIn, Arnold Shields. I'd love to hear from you. Include your questions on future discussions and episodes. Once again, I'm Arnold Shields. This is the 255. Thanks for listening and see you next time.